Hello and welcome to the Tax Roundup for February. And inside this month, we're going to take a look at a new discussion paper out from Treasury on the taxation of an individual's fame or image. Now, this is an area where we've expected some change for a while. Then we're going to take a look at a case that's come up that deals with foreign income tax offsets and some of the problems that can occur there. But first up, Michael's going to take you through some of the pivotal legislation we're still waiting for that's before Parliament. Across to you, Michael.
Now, Parliament doesn't resume until mid-February, and we're not sure how much work they're going to be able to get through over the next few months. But we just wanted to bring you up to date with a few key pieces of legislation and where they're sitting at the moment. Now, the first one is around the proposed changes to the main residence exemption rules for non-residents. And I'm sure lots of you would have had clients who are concerned about these changes, contacting you to try and find out what they should be doing and where things are up to. Now, the short answer on that one is we still don't have any law around that. It's been a long time coming, but at this stage, there still is not legislated. That change is not legislated. Now, what that means is that the proposed transitional period is fast approaching. What the government had said would they would change the rules, but allow people who owned those properties affected potentially by these changes at budget night 2017 to sell them by 30 June 19 and still take advantage of the existing rules. But as that deadline approaches, that transitional rule deadline approaches, I guess it leaves clients thinking, well, what should I do? Are the rules going to change or not? If they do change, will the government potentially extend that transitional period or not? And at this stage, we just don't know the answer to those questions. We'll certainly keep you up to date, but we just wanted to let you know that those changes still are not yet law. Second one, just to briefly note, is the expansion of the single touch payroll provisions. At the moment, single touch payroll applies to employers with 20 or more employees. From 1 July 19, the government wants to basically expand that out to everyone. So employers with less than 20 employees would be brought within that system from 1 July 19. Now, the bill containing those changes did go through the Senate, but it's been handed back to the House of Representatives, because there are some amendments in a completely unrelated area that need to be considered. So once again, we don't have legislation that's been enacted on that change yet, but it does seem quite likely that that will go through at some point, and those employers, smaller employers, will probably need to start thinking about how they're going to manage that from 1 July 19. Now, the ATO has said that in terms of managing that for smaller employers, they're hoping that some low-cost, simple solutions we put in place, and apparently a number of software developers are working on developing products that might be suitable for smaller employers. And the ATO has started to give a little bit of information on what that might look like. But again, that's not yet law. Hopefully, again, we'll have some certainty around that in the coming months. The final thing just to mention briefly in terms of legislation is for over a year now, there's been this bill before Parliament which seeks to introduce a similar business test for company tax losses. So in addition to the continuity of ownership test and the same business test, the government is planning to introduce a similar business test, make it a little bit easier for some companies to utilise their losses. Now, that has sat there in Parliament for quite a while now, not a whole lot of progress, until quite recently, when again, Senate finally has kind of looked into that bill. Again, it's gone back to the House of Representatives because there have been some amendments made. Don't appear to impact on this similar business test. So it may still well be introduced at some point, maybe shortly, but it isn't yet. So once again, we're left in a bit of limbo in terms of will it or won't it, and when will it be passed. But at this stage, those three pieces of legislation, there's been some progress in some cases, but none of those are law yet. We're going to have to continue to see what happens in Parliament when it resumes. And again, we'll let you know as we find out more on that and other bits of legislation flowing through the system.
Now from Treasury, that discussion paper on the taxation of an individual's fame or image.
Now in the budget last year, the government announced that some changes would be made to tighten up the way the tax rules apply to income derived from the commercial exploitation of someone's fame or image. And clearly the ATO had had a bit of an interest in this area over the last probably couple of years or so, if not more, and the government has decided to step in and do something about it. Now, we don't have legislation yet, but what we did have just before Christmas was Treasury releasing a discussion paper explaining, I guess, this area, what the issue is and how it's likely that it's going to be dealt with. Basically what the government wants is that any income derived from the commercial exploitation of someone's fame or image will be taxed in their hands personally, regardless of how their affairs have been structured. Now, in the past, what the ATO had indicated in some guidance was that someone potentially could assign or license certain rights to, for example, a related company or related trust, so that income relating to someone's image or likeness, etc., through sponsorship or marketing arrangements, could flow through into that company or trust. And because that income was not classified as personal services income, there's a bit more flexibility in terms of where they got paid out and how it got taxed. So you might then be able to have that income paid out to other beneficiaries of a trust, for example. Now, the government has indicated that it doesn't like that and it doesn't think that that should be allowed to occur, and therefore some legislation we put in place to prevent that from happening. So regardless of the way those rights are structured, regardless of how they're held in terms of a business structure, the government wants to make sure there are rules in place to make sure that the individual is taxed personally on the income generated in relation to their fame or image. So, discussion paper at this stage, we'll probably see some draft legislation on that at some point shortly. The proposed start date for that change is 1 July 2019, which is coming up pretty soon, doesn't leave a great deal of time for draft legislation to be put in place and then to pass through Parliament, but that is the proposed start date at this stage. Time, if you haven't already, if you have clients who might be affected by this, sports people, celebrities, others with a reasonably high level of fame, those are the people who will likely be affected, and it's time to start thinking about what the impact will be on those people.
And for cases, that foreign income tax offset and where the problems can occur.
Now, I've seen a federal court decision recently which looks at quite a common problem area in the context of the foreign income tax offset rules. And this is the Burton case that was heard by the federal court. Now, brief facts for the case were that the taxpayer was a resident of Australia, but was taxed in the US on some real property related assets. And because those assets have been held for more than 12 months, the rate of tax paid in the US on the capital gains that were made was lower. It was around 15% tax rather than the normal rate of around 35% tax. Now, as an Australian resident, the taxpayer was also taxed in Australia. Because those assets have been held for more than 12 months, qualified for the general 50% CGT discount. Now, the question then was, well, how much of the foreign tax paid in the US would qualify for a foreign income tax offset here in Australia? And this is where we get to the problem area and something that a lot of people encounter when it comes to capital gains. What the taxpayer argued was that they should be entitled to a full credit for the tax paid in the US. But the ATO took a quite different view. The ATO said the way the foreign income tax offset rules work is that you're only able to claim credit for foreign tax paid to the extent that it is paid on income included in your assessable income here in Australia. And the ATO said, well, the assessable income relating to those gains in Australia was the net capital gain after applying the CGT discount. That is, only 50% of the gain that was taxed in the US was included in assessable income here in Australia. Because of that, only 50% of the foreign tax paid in relation to the gains qualifies for the tax offset here. Now, the federal court agreed with the ATO and said that the ATO's approach was the correct one under the legislation. That is, you're only entitled to claim a credit for foreign tax to the extent it is paid on an amount included in assessable income in Australia. Capital gains, it's only the net capital gain that's included in assessable income. So only half of the capital gain was included in assessable income, so only half of the foreign tax could be claimed as a credit here in Australia. The court also had to look at whether that was consistent with the double tax agreement that Australia has with the US, and the court said it was. There's nothing in the DTA that suggested that that was an inappropriate outcome. The DTA says Australia needs to provide credit, but doesn't specify exactly how that should be calculated, so we go back to domestic rules, and the federal court said the ATO had done that correctly. Now, as I mentioned at the start, this is a common problem area, particularly with capital gains which are being taxed overseas and in Australia. And it's because it's the net capital gain as it is included in assessable income. So where clients qualify for things like the CGT discount, the main residence exemption, they might have some capital losses, small business CGT concessions. In some cases, cost base of assets is reset under the Australian rules to, say, a market value at a certain date. All of those things can have a pretty significant impact on how much of the foreign tax that's been paid overseas is claimable here in Australia. In some cases, what can be claimed in Australia is a very small proportion or even none of the tax paid overseas. So something to be very careful about when you're dealing with clients who have maybe foreign assets that are being taxed in both countries. Before you go and tell your client that they can get a credit for all the tax they're being paid overseas, you do need to go back to the way the rules actually are structured and double check exactly how much of that would they claim so that we can give a bit of a more accurate idea to our clients in terms of what they'll get back as a credit and therefore what tax they'll have to pay here in Australia.
And that's the tax roundup for this month. Start the year the right way. Get in contact with Knowledge Shop and take a look at our help desk, our work papers, our checklists, our newsletters, and a whole lot of other things that make the lives of accountants so much easier. Give the team a call on 1-800-800-232 and we'll be happy to show you what we do for thousands of accountants across the country. Speak to you soon.